Welcome to the stock play of the day. Today's stock is symbol DG, Dollar General. We'll discuss should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst for Ally Invest.
And I'm Lindsay Bell, Chief Investment Strategist at Ally Invest.
Well, Lindsay, we had a very tumultuous week last week, and we see the S&P 500 index battling to stay positive right now. What do you see going on in the markets this week?
Yeah, I mean, this morning when we opened, it felt like a big risk-off day, especially after last week, which the market, the S&P 500, declined 4.8%. But a reminder, the three prior weeks, the S&P 500 ended the week up 3% or better. So last week felt like we were taking some of that risk off the table. We felt like it might have been a continuation today, but now you see the NASDAQ has gone green, and the other two indices, the Dow and the S&P, are looking to go green. We'll see where we end the day, I guess. But a lot of the risk-off tone last week and going into this morning was all about the coronavirus and the fear of a second wave and the extension of the period that we're going to have to be dealing with the coronavirus and potential partial shutdowns around the globe, or excuse me, around the country. We saw 12 states over the weekend see it tick up in their coronavirus case count, and the total number of cases in the U.S. crossed 2 million. So that was a little bit of negative news over the weekend. But you see this morning that with that risk-off tone, we saw some of the bigger names that have been that got beaten up last week, like the airlines, the cruise lines. Again, down this morning, where you have the work from home trading names kind of leading the way higher this morning, like a Netflix, a Twitter. I think Shopify was another one that was up in early morning trading. So we'll see how the day continues. I think I know you have the chart of the S&P 500 here. You and I both look at the technicals. While the reopening trade and hope trade was leading in the market higher in the prior 3 weeks prior to last week. Last week, I think it became more of a story of technicals and investors looking at those technicals really as a sign of direction. And what we're seeing, I think, play out today and even at the end of last week is that 200 moving day average. Right now it's at, or going into today, it was at 30.13. That's become a pretty key level that the market seems to be playing with here. Of course, the more days that we can close above that level, the better. But also, Brian, you and I spoke a couple weeks back when the index crossed above 3,000 in general. We talked about how that big round 1,000 number can be a difficult place for the index to just easily glide above. Sometimes you have to retest it a couple times before you can keep moving discernibly higher. So I think that's kind of what we're seeing. We did see last week, though, Brian, the VIX index, the fearing index, indicating, especially towards the end of last week, that some nervousness has re-entered the marketplace. And I think that the trading that you're seeing today and towards the end of last week has just been really choppy. So I think that's something that we're going to have to continue to watch in the weeks to come, because volatility might be here to stay at these levels, right? What are your thoughts, Brian?
Right. Well, if I look at the VIX, and I'm going to pull up a chart here, but you see a lot of the green here in the marketplace, just going back to last week. Actually also had a lot of green that followed the green days in the SPX. So that's counterintuitive. VIX is the fear index. That's another nickname for the VIX index. It tracks the volatility in the S&P 500 index. So when people get nervous, they buy options, and that generates volatility and makes the VIX go up. So one of the big things that we saw is, while we were having a fairly decent rally in the market, the VIX kind of stayed flat and actually had a few up days while the markets were actually having some flat to up days. So we didn't see the drop down in the VIX. It got down to about the 25 level, but that's still extremely high volatility overall back in the day. Now we saw that after the big downturn on Thursday, the VIX skyrocketed up. It went above 40 once again, and right now it's trading right around 38. So the fear is still in the marketplace, and until we can get a sustained move and we can actually see the VIX come off, there's really any move to the upside is always a nervous move, and that we could always get a pullback at any point in time. And that's really all that the VIX is telling us here. And obviously the VIX was forecasting that we were getting a little bit overdone on the upside after the big moves of last week, and now who knows where we're going to end up at. But that 3,000 level that you mentioned in the S&P 500 index, to pull up that chart again, that is a very important level, and I think today is going to be a big determinant as far as what's going to happen for the rest of the week. If we can close above the 3,000 level, that would be very good for the markets. Below would obviously be very bad. And that's always where all these numbers are congregating. We have the 50-day move or the 20-day moving average just above it. We have the 200-day moving average, which a lot of people are really paying a lot of attention to, right just above that 3,000 level. And then we go all the way down to the 50-day moving average, which is all the way down here. And if we do close below, I think the 50-day could be in play overall. All right, so let's get to our stock today. We're looking at, well, maybe a recessionary trade, if you will, Dollar General. What are your thoughts on Dollar General in that sector overall?
Yeah, Brian, we're taking a look at Dollar General today, and just before I get into some of the fundamental analysis that I do, I would just remind our viewers that this is anything we say or do here is not to be considered a recommendation. It's really just educational material for you to think about and learn as you are on your trading journey. So I look at this chart of Dollar General. Wow, look at that, right? I mean, it's straight up and to the right. In fact, if you go back to the end of 2018, the stock has doubled from 93 bucks to about 180 and change. So it's been quite an impressive run. And, you know, it can be nerve-wracking looking at a stock chart that looks like this and really being able to find the confidence to enter it when the stock has risen this swiftly. That's also why we sometimes like to look at options trades, because it helps you manage the upside and downside risk of a stock a lot easier than just outright buying the stock can sometimes. So anyway, when I look at Dollar General, Brian, you're absolutely right. This is the type of retailer that actually will do well in a recessionary or slow growth environment. A lot of times customers are attracted to these dollar stores or value-oriented concepts in that type of environment because they're looking to stretch their buck a little bit further than normal. And you saw that these guys actually reported earnings at the end of May 28th. So fresh out of that event. It was a really strong quarter. The quarter ended on May 1st. Same-store sales for the quarter were up 21.7% in the quarter, and management told us on the earnings call that trend actually continued to get a little bit better in the month of May. They had data through the 26th, I think, and they saw same-store sales increase 22% from May 1st to the 26th. So a tiny bit acceleration from what they saw in the first quarter. A coronavirus play here, right? They're benefiting from the need for things like toilet paper and canned goods too. So that's certainly a positive. What also the management team had told us was that they're seeing new customers come into their store, very similar to what they saw during the 08-09 crisis after the great financial crisis. And so they're getting more customers. They get that information by reading credit card data, so they know they've got some new folks in their stores. A lot of their customers are first-line respondents. This is a company that also has treated, as an essential service, has treated their employees very well throughout the process, giving them a bonus for their work going into the coronavirus. So they're treating their employees very well, like many companies have done a lot for their employees as much as they can. They do, however, benefit. Well, they do believe they can continue to benefit from the momentum and the trends that they've been seeing in their department stores. By the way, they've actually seen operating margins and gross margins increase over the quarter, which is a very good sign. Markdowns were lower than expected, markups higher than expected on the inventory that they have been receiving, and their cash flow from operations at $1.7 billion is a nice cushion for them to work with going forward should we go into another shutdown or slowness period in the economy. So I think these guys seem to be well equipped for whatever lies ahead. Now, management, importantly, they didn't provide a update really to guidance. They updated a couple numbers like CapEx, but sales and earnings per share and things like that, they haven't updated what they gave in March. And they said they're not in a position to be able to do that. But with that being said they think they're going to be able to come in better than what they provided in March. So that's a positive sign when you think about the future, right? So those are the types of things we're watching. Of course, on the flip side of this, their customer base, Brian, because they are lower income, has benefited significantly from those stimulus checks and the increase in unemployment benefits. So they're certainly benefiting from that. And, depending on what happens at the end of July when some of those benefits expire, they may see an impact to that. But it felt good to hear management's tone on the earnings call at the end of May. So look, the stock clearly has momentum behind it. It's a better position than other stocks like a Dollar Tree when you're going into a recession, given their broader set of merchandise and products that they offer and their location. They're in very rural locations that is underserved by the retail community in general too. So that's a lot to think about from a fundamental perspective. But like I said, that chart can look a little bit intimidating to dive into, Brian. So how would you approach it from an options strategy perspective?
Yes, and we haven't talked about a covered call just in general, I don't think, on the stock play of the day. It doesn't come up that often because you're literally looking at buying stock. So I'm going to look at the concept of a covered call, and then I'm going to give you an option, a 100% option alternative. So here on the option chains, this is the Ally Invest option chains, we see that the stock, oh, wow, it's really skyrocketed just recently, is up today. And it was kind of interesting. We did see the markets open down. The S&P 500 index opened below 3,000 today on the open. It was a little bit of a scary open. But Dollar General was flat all day, and now it actually looks like it's thriving a little bit. It's up 2.5% right now. At 189.04. Okay, fairly expensive stock. If we want to buy 100 shares of it and sell a call against it, it's going to cost us $18,905 plus commission to do that trade overall. And what I would look to do on a lot of these stocks that are a little bit frothy overall, I like to try to protect myself by bringing in some premium in the short term. So there's so much juice in the marketplace. We got the VIX above 40. We got the implied volatility just on Dollar General. If I look at this, it's at 33.5 on Dollar General. On a normal, back in the normal times, if we can use quotes around normal times, because this might be the new normal going forward. But back in the day, this would have traded around 15 or 20% implied volatility on the short-term options. So we still have we have a fairly expensive stock and we have a fairly jacked up implied volatility. So the way that I would approach this is I would look at buying this underlying stock if I could. Now, once again, not meant to be a recommendation. We're just trying to learn here. But when I have this situation and I'm kind of getting nervous, like, gosh, it's up 5 today. Do I really want to jump into the marketplace? And sometimes you just don't do anything whatsoever. So this is one way that you can get in and lower your cost base initially when you first put on the trade. Now, you give up some upside potential on that underlying stock, but a lot of people in this marketplace just want to be able to get in at a decent price overall. So what can we do? We're going to buy that underlying stock, and then as soon as we get that executed, we're going to sell a call against it. Now, if you did it all as one trade, that would be considered, they call it actually in the industry, a buy right. I'm buying the stock and I'm writing a call or selling a call against that position. So let's say we bought that 100 shares. Our trade would then be to sell a covered call against it. And I can go out here 11 days just to try to show you the type of premiums that you can get and why covered call writing is interesting in this marketplace. If I go and I look at that, if I sell the 197.50, right? The stock is at 189.05. I guess I could have scrolled down here, 189.05 on the call side. And if I sell that 197.50, that gives me, let's call it 8 points of upside, about 5% before it gets to that underlying strike. And at this point in time, I can bring in, it looks like $1.15 by $1.40. Let's call, for the paper trade's sake, let's call it $1.20. So I can bring in $1.20 worth of premium, saying that I'm just willing to sell that stock at $197.50, basically 8 points higher than where it's currently trading right now. So this is a way that I can get into that and say over the next 11 days, this will give me a small pillow to land on. And if the market does go down, okay, then that means I can collect my premium and I still got in at a decent price. So this is a way of approaching stocks that are a little bit, maybe got a little bit past itself. But you never know, especially in this marketplace. And as Lindsay said, this is an interesting industry. If we do have rough times, and until we get a cure for that coronavirus, I think the rough times are ahead of us, just in general, until we can figure out what we're going to do with this virus and this issue that we have. Now, I promised you that I was going to go a little bit longer today, and I was going to talk about a 100% option trade. So because this is a $189 stock and buying 100 shares of it will cost some capital to do, one way that you can also approach it, and I'm going to highlight it inside the options playbook, is something that we call the fig leaf in the playbook, otherwise known as a leveraged covered call. So instead of buying a $189 underlying stock, one thing that we can do is go out further in time and buy a long-term option. Now, in the marketplace, we call that a LEAP. It doesn't really mean anything. It's just a marketing term by the Chicago Board Option Exchange, to be blunt. It stands for long-term equity anticipation securities. But overall, if I look at a longer-term option contract, and that's why I have this chain available here, the June 15th is what I'm looking at, 215 days out, not quite a year, just under a year, 214 days. And if I go a little deeper in the money, I'm going to buy the 80 delta option contract. Now, 80 delta means that this option contract will basically act like owning 80 shares of stock. So the stock goes up one, this option contract should go up by 80 cents or $80, but it's going to be an expensive option contract, but not as expensive as comparative to the stock. You're looking at $40.30 by $40.90. That's the 155 strike. This is the issue with longer term options, though, is a lot of times you'll get wider bid-ask spreads. Dollar General has a decent amount of open interest and a decent amount of volume. This isn't bad for a longer term option contract, but that's the biggest concern of trading this strategy as opposed to doing the covered call outright. So the second paper trade, I'm giving you a bonus trade this week, would be to actually do the fig leaf. And that just means that we click once here and that puts a buy. And this is our workbench down here. So we're paying $40 for this. And we got something that acts like the stock a little bit, but it's not the stock, right? We're only getting 80% of the stock price representation on the upside. And also you don't own the shares. So if you were to get called away, you're going to have to do something. So hence the name fig leaf that we came up with is because you're kind of covered. You don't own the stock 100%, but you own something that's like the stock. Now, as far as your brokerage firm is concerned, they would consider this a covered position in that you own a longer term option at a lower strike than the one that you're selling. But this is one other way that you could participate in this underlying Dollar General. Once again, this is not meant to be a recommendation. We're just talking about potential strategies on frothy stocks overall. All right. Well, I don't know if we have a question available. I think we have a question from last week, Lindsay. I think we might want to address. Is there something from last week?
Yeah. We got last week, unfortunately, sorry guys, we had a little technical trouble with our noon taping, so we're doing it live now a little bit later than usual, so we don't have the chat function working. We'll be back next week though, and don't forget too, before I get to this question, Brian does Stock Play of the Day overtime on Fridays at noon, where he will review this strategy with you and make any adjustments or suggested adjustments that he thinks might help you continue to hold this strategy or execute this strategy, I guess is a better way to say it. But we did normally, like I said, we usually take live Q&A But we don't have that today. We did get one extra question last week that I thought I'd post to you, Brian, from Mr. Money Coach, that said, if you could only trade one option strategy for the rest of your entire life, what would it be?
All right. Well, I'm going to answer that a little bit. If I could only trade one option strategy, I probably wouldn't trade options, because one of the biggest things about options is that you can hone your strategy to kind of meet your forecast. And if you're correct on your forecast, you should be profitable on your option trade. Now, if I had only one overall, I think I'd want to do spread trading, just in that what we looked at today was a fig leaf trade. And that's a form of a spread where you're buying one option and you're selling a different option. And that's mainly because you're controlling your time premium by buying an option contract that does not like time decay and selling an option contract that does. But overall, the biggest thing, and then one of the biggest benefits of options, is that you have so many different ways that you can hone your strategy to meet your forecast overall. All right, Lindsay. Well, you want to do a quick review here on the indexes, where are we at, and a little bit of a forecast for next week?
Sure. I feel like I should just take a look at my screen quickly to see where the indexes are, since it's moving quickly so today. Yep. We still got the Dow and the S&P 500 in the red and the NASDAQ in the green. The VIX still up at 36, but lower than where it opened. I think it opened at 40 or above this morning. So we're still having a mixed picture, still some choppy trading out there through the day. We still think technicals are likely to be the key driver of the market, at least near term, around that 200-day and 20-day moving average in the 3,000 to, what was it, 30, 34 or something?
30, 34, yeah, it turned up a little bit on the 20-day moving average, yep, overall.
Yeah, so I think that's where we're at when it comes to the index.
Yeah.
What about the options trade?
Right, a key number on that index would be that 3,000 on the close today. If we can stay above it or below it, that'll be a big number today, technically. On the option trade, I gave you two different trades today. The fig leaf is an interesting alternative. The biggest issue about doing the fig leaf is that you're going to have a fairly wide bid-ask spread that you're going to have to deal with comparative to buying the stock outright. Well, that's it for this episode of the Stock Play of the Day. Please click subscribe and ring the bell to make sure that you get all of the alerts every time we have a Stock Play of the Day. And this Friday, I'll be back at noon Eastern time once again to talk about the Stock Play of the Day overtime, and we'll review the strategy that we just looked at. Thanks for coming, everyone.
Don't miss the overtime show. Brian will keep you up to date on the trade.
Thanks for coming.